enjoy working in. Many of you on the webinar are probably looking at this, and if it's not an area that you work in now, looking at this as perhaps an opportunity, something that you might be able to pivot into, particularly in I guess what's a hardening market as we've experienced over the last kind of 6 to 8 months in lending. With rates rising, obviously, and the challenge that's had on borrowing capacity and others, and the impact of that in terms of the amount of leads and whatnot coming through the door. And certainly, it is an opportunity. It's one that I've found quite fruitful. I'll take you through a little bit of that now. So, self-managed super fund lending in Australia. So in Australia, there are some 600,000 self-managed super funds. And, traditionally we see kind of mum and dad or, husband and wife in those funds, often see business owners as well, but generally those kind of two-member funds. 6% of those, according to the ATO stats, have a limited recourse borrowing arrangement for property on them. So we'll get into that in a little bit. What's an LRBA and how does that work throughout the presentation? So by my maths, that means that there are some 36,000 plus self-managed super fund loans out there in existence in the marketplace. And the ATO stats tell me that there is some $55 billion in SMSF lending. So certainly it's an opportunity. It's a reasonably niche opportunity when you compare it to the broader kind of commercial and residential market, but an opportunity all the same. I love it as a niche. For me, I work with a lot of financial planners and accountants, so naturally being good at SMSF lending makes sense in being able to work with them successfully. It is almost a little bit of a Trojan horse into the type of clients that I like to deal with. Those that have got SMSFs generally, and I'm speaking generally, more affluent, are generally earning higher incomes, whether they're self-employed or PAYG, and have an active interest in this space, and are also open to advice. They're generally dealing with other financial professionals like accountants and financial planners in this space. In 2020, this was a Vanguard report that was done. There were 21,000 new SMSFs that were established, and the motivators were classed into kind of 4 key groupings. And typically what we see with an SMSF member that's setting one up is they want to take control, and that might be control from a performance point of view, what they're invested in or fees. But typically they're wanting to invest in property and using that as a wealth creation vehicle to kind of broaden their property portfolio, and that's where we as SMSF specialist brokers come in and can assist. So certainly there's a strong opportunity out there in this kind of niche space. One of the things I wanted to go through next is just some of the stats, and I'll start with net SMSF establishments. So net SMSF establishments is funds wound up or finished for the year, coupled with newly started SMSFs for the year. And if you go back a couple of years to 2018, net establishments were only 233, whereas in just the financial year 2021, not too recently past, net establishments were 12,413, so quite a swing. And what that's showing us is that SMSFs are regaining their popularity, less are being wound up and more being started. In addition to that, we're seeing the average age at establishment falling. So the average age kind of, in that period 2006 to 2014 was 51. In the last couple of years, we've seen that drop to 46. And, that 35 to 44 age group is the most popular in which we're seeing to establish an SMSF. So if you're looking at, targeting, whether it be from a campaign point of view or whatever, they're the kind of age groups that you're looking at here. We're looking to take control of super and build wealth via property. Some of the facts. So I'll get into some of the facts here about SMSF lending. With regards to the lenders, I'll start with, and we're going to deep dive into each of the lenders that kind of operate in this space. And I think, this might dispel a few myths around the lenders in this space, because I think there is a misconception that there are very few lenders in this space. Certainly compared to resi or commercial, there are fewer, but there is quite a selection there. if I go back to 2016, back then you had the majors, St George, Australian Unity, and several other lenders that were all, and Macquarie, that were all lending to SMSF lenders. In 2016, ASIC released a report. I can't remember the name of the report, but it was it essentially spooked the lenders that were in the market at that time, and many of those lenders exited the industry. Sorry, not the industry, exited the SMSF lending space. And what we're seeing is that there's still a lot of those kind of 36,000 loans that I mentioned before that are in existence that are still with the majors, Macquarie, St George, etc., on those kind of legacy products. They're no longer lending to new clients, but there's still obviously some existing lending in place. I'm often seeing clients paying a royalty tax of kind of 1% and 2% commonly with that, which creates a really strong refinance opportunity with some of the lenders that are on panel. On my panel, and I must admit this presentation is kind of limited to the ones that I had really ready access to, which were on my panel. I'm an AFG broker. We've got 8 mainstream SMSF lenders, or 7.5. One of them I'll talk about is a new entrant coming in very shortly. We'll go into each of those lenders in a bit more detail in a moment. And there are 2 private SMSF lenders that also have a place there as well. In addition, there are a couple of extras. So that panel, across the board, maybe more like 11 or 12 lenders across the country. 3 facts that I want to go into now, which kind of set the scene for, if you're making a decision around whether this is an area you want to get into, is to go into it eyes wide open. Certainly, what I've found in this space is it is complex. If you don't have a reasonably deep understanding of superannuation, trust structures, and how trustee companies and trustees work within this space, if you're going to go into it, you need to ensure that you're surrounding yourself with the right kind of mentor that can help you with that, whether it be another broker who's an expert in this space that can assist you. I would recommend more so aligning yourself with a financial planner or an accountant that might be in your network that specialises, that can help you through your first kind of up a dozen plus deals, because it is a complex space, and if you haven't done it before, certainly getting that instruction can be very, very useful so you don't get it wrong. So because at the end of the day, the next one, it is a regulated space. You need to have a very good understanding of the legislative environment that superannuation is regulated by. And this isn't about NCCP. In fact, for 99% of SMSF lending, these are non-NCCP deals. They're treated as commercial deals, and those normal NCCP guidelines aren't necessary. In our business, we treat every loan, whether it be a self-insured fund loan or not, as we would an NCCP loan from a compliance point of view, and give it that treatment. And I'd suggest that's a prudent way to approach this space as well. But also having an understanding of, the SIS Act, conditions of release and other things that kind of regulate this space, I think is really important. And finally, it is more involved. There's more. Sorry. Just moving this out of the way. There's more loan parties. So there's 5 different parties to the loan, which we'll cover on. There's more third parties, meaning involved in this process, not just the solicitor and the vendor, but you've got the financial planner, you've got the accountant, and of course the lender involved as well. So there's more people to keep involved throughout that process, and there's just more paperwork. Everything in SMSF lending, in my experience, takes longer, and I'll give you some guidance on how that works with a slide later in the presentation. But it is clunkier, and there's more paperwork, and it's typically more manual. I'll pause there. Xiaoming, did you want to add anything to any of those facts before we press on?
I think you've covered it very, very well. I think that, with the likes of the 2017 Royal Commission, suddenly the big 4 banks exit out of the industry because of their copious amounts of regulation. And that's sort of brought a lot of opportunities into some of the non-major banks. to come in. But having said that, it doesn't mean that you have to really step to the tier twos and what have you to be able to get great rates and things like that. In 2021, there has been a little bit of a policy change within the SMSF structure, which made, I guess, risk from a lender's point of view a little bit less. In that, all of a sudden, which I'm sure Mark is going to go into in a little bit later in terms of different parties involved in the SMSF. The main difference that happened last year is that now the same entity within the self-managed super fund that holds the loan also holds the title. So all of a sudden, risk to the lender is a lot less. And as a result of that, you have more lenders participating in the space, which in turn provides greater or better rates offered to people in the market. And that's a really exciting thing to see for, I guess, our clients and our borrowers as well. I know that, Mark, later on in your slides, you will go through some of the, I guess, regulatory requirements, considering things such as you touched before, the minimum amount, recommended amount for an individual start an SMSF. But also the part that I want to touch on right here is that your last point where it says there is more documents involved. Yeah, there are more loan parties. Yeah, there are a few third parties, and there's a few more bits and pieces of paperwork. But the really important thing for brokers to remember is that even though there's a lot more paperwork involved, when it comes to the assessment process, it's actually a lot simpler than it would be if you go through an individual loan borrower. Because in an SMSF environment, the way it's structured, it either works or it just doesn't. So there's no such thing as really you've relentlessly worked a deal for weeks and weeks and weeks and weeks only to work out it will get declined. It's actually not like that. So once the right paperwork is in place and you understand the party that needs to get involved, these deals are actually not too cumbersome. They can actually get done quite well once you get the hang of things.
Beautiful. I agree.
The other thing I just want to add before we go on, and I just want to take up Mark's point there, it is complex, it is involved, it is regulated. So one of the ethos that Mark and I and Xiaoming share is you've got to do the work. There are no shortcuts in SMSF lending. And people are asking on the chat, can I get a copy of the slides? The slides aren't going to do the work for you. We will post a recording on the Learning Hub, but you've got to do the work. You've got to take notes. You've got to process that. You've got to apply it to your own business. If you want more training opportunities in SMSF lending, the MFAA can connect you with more opportunities. All you need to do is send me an email and I'll connect you with other opportunities available. But you've got to do the work. You've really got to do the work. We can't stress that enough. Back to you, Mark.
Yeah, 100%, Zarko. Well said. I was going to cover that later in one of my slides, but I couldn't agree with you more. And I'm deliberate about not providing the slides because this is a labour of love for over the last 18 months. I've been working on this presentation to the point where it is now and developing the skill set, interviewing the lenders, and that's what's enabled me to become a specialist in this space. And if you do the work, getting that knowledge and applying that will be a lot better. So onto the SMSF lenders. Yeah, this was the space kind of 5 or 6 years ago. The majors, Macquarie and others. This is the space now. Noting, these are the ones, as I said, that are the ones I work with closely that are on my panel. There are others, obviously Doe Money, which Xiaoming represents. We've got a slide on that later as well. There's Mortgage Easy. There's Mortgage House, Mortgage Mart. I think a couple of others, Blue Bay. In addition to these, but these are the ones I've kind of focused on today. So you've got quite a good selection there across, AFG, Think Tank, First Mac, Granite, Liberty, Latrobe, and then Bluestone joining the market. There's a couple of new entrants just on this list alone in the SMSF space over the last kind of 12 to 18 months. And these new entrants are starting to kind of, are great from a broker point of view, great from a consumer point of view, because they're putting downward pressure on fees, they're putting downward pressure on the rates, and in addition to that, there's some product innovation coming in as well, which is creating some opportunities to have those discussions with existing SMSF loan holders. So some really great offerings there, which we'll get into in detail later. At a high level, this is kind of the lender overview of those 7 lenders, sorry. All of them do resi. That's a no-brainer. You kind of drop a few off when it gets to commercial. I must admit that Latrobe commercial should be a tick. That's an error. Apologies. Latrobe do commercial. Sorry, Scott Shine, if you're on the call. From a pre-approvals point of view, all the lenders bar one do pre-approvals, and most of them will do pre-approvals for funds to be set up. So you might be talking to a client who's got an interest in setting up a self-managed super fund, and wants to get a pre-approval in place prior to doing that and rolling over all their funds. They want to make sure they can get it done, and so most of them are going to provide that. I've got a column there called lodgement, and this is kind of highlighting the more cumbersome process involved here. Unlike traditional kind of resi, where everything is largely done through your aggregator software into AOL. The lodgement process is a bit of a mixed bag when it comes to SMSF lending. So having really good processes and procedures and I guess training for your team to manage this, if you're riding across multiple lenders like we are in our business, is quite important. From Liberty's point of view, it's a pretty manual process for commercial, and resi. They can do resi through AOL. I've never done one through AOL, I must admit. It's always been manual through their paper. The application process, the paperwork's pretty straightforward once you know what you're doing with it. First Mac's got a really good broker portal, both their servicing calculator and their submission process on First Mac's pretty straightforward. Granite Home Loans is all now done. Used to be manual, all done through Loan App online now. So we've got a pretty good system in place for that. The Latrobe's all manual via paper. Think Tank's quite good. If you're an AFG broker on the call and you're registered for or accredited for AFG Business, you can write SMSF loans through the AFG Business platform. If you're a newbie to this space, that's actually a really good way to do it, because the AFG Business platform kind of pushes you through a process that kind of is follow the bouncing ball, and you can't mess it up. Well, you probably could, but you should be able to follow that and not mess it up. So it's quite a good process. It's otherwise manual for other brokers. Better mortgage management is manual, and AFG Home Loans Retro can be done through Flex Online or manual as well. So that's the high-level lender overview. The next one is, getting into this space is you really want to have an understanding of how does a limited recourse borrowing arrangement work? What's the process flow? But, what is a limited recourse borrowing arrangement in a nutshell anyway? Understanding, this is where we get into the parties to the loan, is what are each of these parties and what role do they play in an SMSF loan? Because these are, in particular, the bear trusts. But how it works, I guess, at a high level is that the nature of a limited recourse borrowing arrangement means that the lender has limited recourse in terms of the assets that they can go after if things go pear-shaped or payments are not made and they need to go after the security that they're lent against. So let's say that happens. By virtue of the bear trust and the bear trustee, the asset is held in trust in the bear trust. And the lender can only ever go after the asset, and they are limited and cannot go after the other assets of the self-managed super fund. That's what it means. So essentially, the SMSF pays the deposit on the property. A bear trust is set up within the self-managed super fund, and that holds the property on trust for the SMSF. And the bear trustee holds the title to the property. So at settlement, the vendor is transferring ownership of the property to the bear trustee. This is really important because when you're talking to your clients and they're going through that process of acquiring a property, the bear trustee is going to hold the title to the property and therefore must be identified on the contract of sale. So it's not the XYZ super fund that's on the contract of sale, nor the guarantees, mum and dad, Joe Public, or guarantors, sorry, the members that are listed on the contract of sale. It's the bear trustee, and that's really important. And then the lender's taking a mortgage over that property held by the bear trustee, and the SMSF is holding a beneficial interest in that property by way of its payment of the purchase price. And the structure of that bear trust document. It's reasonably complex. Until you do half a dozen of them, it might not be clear. And this is why as you do those first ones, it's good to get strong guidance on them from an accountant or a financial planner that you're friendly with in your network that can help you with this. Lenders are good, but I'd suggest getting an expert that can kind of assist with it, because getting this process wrong can have quite a detrimental impact on your client's retirement savings. And as I said, it's quite a regulated space as well. Xiaoming, did you want to chime in there from a lender perspective in terms of getting the paperwork right and the bare trustee, etc., and any areas you might see more frequently in this space?
Definitely. As you were mentioning, I can just think of a few submissions that we've had. That's because I guess the level of complexity within this chart, if you don't understand it quite clearly, it can really delay the loan processing. Because there is a lot of bits. I think the main thing to understand is, yes, there is a self-managed super fund within that, right? So you can have an individual as a trustee or a corporate trustee. In most of the cases, it's a corporate trustee, right? Outside of that, you've also got a bare trust, okay, which is a separate entity, and that bare trust needs to have a trustee as well. So those are the things that you have to really get your head around. It's really important that to know that the members of the super fund, okay, are also key here, because they also act as guarantors for that particular bare trust. Remember, each bare trust can only hold one property, right? So you can get a very mature self-managed super fund who holds many, many bare trusts. So in case any of you guys are sitting there wondering, is it possible to use the equity increase in an asset in one bare trust to equity cash out for the next purchase? The answer is no. Okay, and this is where the limit of recourse comes in. Each bare trust has one property, right? And then it prevents any risk of cross-collateralizing, right? And within each bare trust as well, the guarantors are also responsible in terms of for the servicing too. So just a few things I want to go through, and that is, when you're going through the application process, I'm not sure what other lenders, I think most lenders have a checklist. At Doe Money, we have a very extensive checklist to help the broker navigate through what's required. And in turn, if you can understand that really well, you can probably explain that to your borrower well, right? So, and that is, remember to have the following. Have the self-managed fund trustee, have a certified, have the SMSF bare trust deed, have a certified, right? Certify the SMSF trustee company, the certificate, this is the ASIC certification. ASIC certification of the bare trust company, right? Get audited tax returns, right, for the last 2 financial years. If you've got a client who just set up their SMSF, that's okay, no problems, not an issue. What they need to have is a 12-month statement from the industry SMSF available for the lender to assess the frequency and consistency of contributions, whether that's employee contribution. If you have somebody who's a self-employed individual, right? For self-employed individuals, they have the flexibility of making lump sum payments, contributions. And sometimes that could be concessional. But also, if you've got someone who has a great habit of putting a little bit more in via the unconcessional portion, that's okay too. Especially if this is something that they like to do and can consistently demonstrate for a 6-month period. That amount of unconcessional contribution can also be used for considered as funds to complete, or in some instances, used to satisfy what we call as lenders a liquidity test. Okay, I'll come back to the liquidity test matter a little bit later, but I'll just run through the checklist. Things like the accountant letter. If it's a brand new SMSF, okay, you need an accountant letter to say how much the auditing cost or annual running cost of that super fund is going to be, right? Not super necessary for a mature super fund, because from the tax returns we can see that, right? Now, any of the existing loan statements, okay, rental income from other bare trusts, existing bare trusts within that, they can be used as service, but there is a haircut. So we take 80%. Well, at Doe Money, we will take 80% of that to service, okay? Letter to confirm the rollover from the industry super fund over. Letter from your employer to show that this is the contribution, the super compulsory contribution we're making for this particular person's salary package, right? You need to make sure that they have their cash management trust account balance, because as lenders, we would like to see things like funds to complete. You know, do you have enough there? And also, again, coming back to this liquidity testing. Now, if you have a super fund that has things outside of property, they may have shares, they may have gold, they may have other things, right? If you're looking at things like that, make sure you have their, I guess, share certificate or portfolio statement or something like that that can show their dividend returns or what have you. The last part I want to cover in this segment before I move on is the liquidity test. Okay. Now, by way of liquidity test, as Mark said, SMSF loans have to be arm's length. So you cannot buy something to live in. It has to be for investment purposes only. Now, that's going to be assumed you're going to have running costs, right? So you cannot get all of your money in a self-managed super fund. As that 20%, if you're giving it 80%, right, as contribution, you need to leave a little bit behind to cover things like your annual running costs, i.e. auditing or advertising, you know, when your tenant goes or what have you, a little bit of maintenance and all that sort of stuff. Different lenders will have different requirements for liquidity tests. Some people don't have those. For Dome Money, we don't have a requirement for liquidity test for anything under a 80% LVR below, but at 80% LVR, we do require that the super fund has a liquidity of at least 7.5%.
Good one, thank you. Yeah, the paper is a really important one. Reference to once being tripped up, and not being ready to staying the parties were it's a really great opportunity not connected with those professionals to get connected with them and introduce yourself to potential resources. SMSF, LRBA parties to the loan, touched on this before. There are 5 parties that you need to be aware of when it comes to an SMSF loan. These are captured in all of the lenders' application paperwork, so being really clear on which is which and at which stage they come in is really important. Of course, there's always the SMSF, you know, the XYZ Family Super Fund, as they're commonly named. Then there is the SMSF corporate trustee, and that is a company. 9 times out of 10, an SMSF is going to have a corporate trustee. It can be individual, so that's just the individual members of the funds as trustees of the funds. We don't see it very often. In fact, I only had one come across my desk this week, and it's the first time in a long time that I've seen that. Individual trustees do limit the lenders. Not all lenders will lend to individual trustees. The next party to the loan is the Bear Trust, which is the trust function that obviously holds the asset, and then there's the Bear Trustee that holds the title. So the Bear Trustee will always be another corporate trustee. So, you know, setting each of those up incurs costs for the clients, and those costs can be, you know, depending on the accountant or provider that's being used, you know, $1,000 or $1,200 each. For the SMSF and the Bear Trust. And then the 5th party to the loan is the SMSF. So this, the SMSF member of guarantors. And this can be up to 6 people. SMSFs used to be limited to 4 people. I think it was over the last 12, 18 months that got increased to 6 people. I must admit I've never seen a 6-person SMSF. I would think that it might be a large family. It could be 3 couples, but it could be 6 business partners. I must admit, the SMSFs that I generally see, those looking to buy properties, occasionally business owners as well. There's generally only 2 people in that particular fund. Loan to value limits. So in SMSF lending, you really are capped at a maximum of 80%. There's no LMI space in this style of lending. From a commercial point of view, you max out at 80%, and that will depend on the asset and the location, and from a residential point of view, you max out at 80%. Those LVRs do taper off, and I guess as you're going out to kind of those higher LVRs, the rate is obviously considerably more. Most of the lenders, if not all of them, have a tiered kind of LVR-based pricing, as you would expect. And you start to see in kind of 80% space with the rates as they are now that your assessment rates are really kind of hitting an effective borrowing capacity. So we're naturally seeing a lower kind of LVR coming in. Regional and rural locations are okay, but generally at lower LVRs. So if you're looking for those higher LVRs, it does require a more premium security in a more premium location. If you're looking to do a little office suite in, say, Sussex Inlet in regional coastal New South Wales, as I did not too long ago, the max we could get was 60% of the trade on that particular asset. And so you can be limited there. Generally, population size is the thing that you're looking for. If you're kind of above 50,000, so you'd be deemed to be kind of major regional or metro, then you're generally pretty okay to go up to 80%. But when you start going sub 50,000 or even sub 10,000, you will start hitting serious LVR kind of limits. Inner city apartments, very similar to our outside of super, generally looking for kind of 50 square metres and above in those higher density areas. As I said, regional securities are harder than this. What are acceptable securities? Look, almost any type of residential and commercial property can be funded, and it'll again, depending on that mix of location and the type of security will depend on how much funding you can get for said security. But we've seen commercial offices, warehouse showrooms, retail, a lot of little units and factories have been doing kind of recently in super. Retail shops, never done a shopping centre, but you can, small office buildings, childcares, and then you can get into specialised security, so motels, service stations and childcares, etc. Can find a home in SMSF for the right type of security in the right location, probably at a much reduced LVR. I'm looking at a pub, freehold pub premises in Bathurst at the moment, and the most I can get on that is 55%, just to give you an example of specialised security. Also looking at a service department in a high-density Fortitude Valley location up in Queensland at the moment within super. Most I can get on that's kind of 60%, and that's a tricky one again because being a specialised security, that's treated as a commercial asset and therefore has a more expensive valuation and process involved. Couple of words of caution around acceptable securities. Make sure you are not letting your clients buy the renovator's delight, where they need to go in and put in a new kitchen, knock down a wall and do some fancy stuff and make it all amazing. You cannot improve securities under this legislation that governs superannuation, so therefore the renovator's delight is not the right style of property. You want to be buying a completed product that will only require maintenance and obviously essential and emergency works can be done, but massive or major improvemements and renovations cannot. Do not buy house and land packages. So two-part contracts are not allowed under the superannuation legislation. So that kind of kills the house and land package style purchase. There are providers out there in the market that will package up house and land packages into a one-part contract for self-managed super funds, and they do have ATO tax rulings that govern them. Quite a clever product. Was only looking at this recently. Haven't got a slide on it today, but certainly they're available and can provide an option to clients that are set on getting a house and land or wanting to go down that path. So there's options there for that as well.
So I just want to say a little bit in terms of the acceptable asset security part. And I guess if you ever get confused, just go back to the point that a self-managed super fund is established solely for the purpose of benefiting people for retirement, right? And whatever reason that the regulators put around acceptable security is so that risk is minimised. And this comes to just remember one thing: you're limited, most likely to be limited to properties that doesn't require material improvement, right? So if something goes wrong, that the lender can easily swap it out. That the SMSF asset is not going to cause you additional financial outlay. It's supposed to be there primarily to generate income for your nest egg. Okay, so again, this is the reason why there's a rule against, don't buy things that's a renovator's delight. You buy run down something, fix it up, and then lease it out. Does it make sense? Is it an investment property? Yes, absolutely it is. But it's a material change to the security that that lender has, and that lender doesn't have the appetite for that. Right. Having also said that, in terms of on the commercial side as well, you sometimes can see people do in-specie transfers on the commercial properties that they own in their own name into their super funds within the SMSF contribution limit for that year. Okay, and your super fund can certainly purchase commercial assets off of your personal holdings. Right, purchase has to be ownership. Okay. And again, and as a lot of your clients must be practicing at the moment, your SMSF can buy commercial properties, and you can rent that commercial property from your business as a place of business and still be fully compliant, because you're still paying rent. That rent is still going to your super fund. It's all compliant. So there's a lot of ways certainly around that as well. SMSF is a great structure, to use. So yeah, there is a lot of limitations. There's a lot of paperwork, but don't be afraid of it. Really, it's a really, really good product to look at.
Yeah, we do see a lot of that. I'm doing a lot of kind of business real property is the technical term that the gentleman's referring to there, of clients looking to bring in their premises that they're going to occupy and lease back to themselves within their super. Really common strategy. They can't be seen to be, it all needs to be at arm's length. They can't be seen to be giving themselves a sweetheart deal and paying kind of overs on the rent and pumping up their super that way. So it all needs to be at a commercial term, but ripping strategy to kind of assist your business growth and obviously your superannuation. In terms of servicing, so Jiaming touched on this a little bit before. Servicing within a super fund is generally pretty straightforward. We're looking for the inflows into the fund, coupled with the rental yield to determine servicing. Lenders have a little bit of a different approach. I'll look at the policy niches later, but inflows to the fund can include obviously rollovers of existing funds, your superannuation guarantee, so that if you're PAYG, that's that 10.5% debt going in, mandated every year. Any additional non-concessional contributions that are going in over the top of that as voluntary contributions, cash reserves, obviously liquidating funds or investments in the fund, related party loans to the fund, and of course the rental yield in the property. What I want to touch on now is the single acquirable assets. So this is something that if you're going to operate in this space, having a good awareness of what a single acquirable asset is important. And in the context of a limited recourse borrowing arrangement, it's any form of property other than money that a trustee is not otherwise prohibited from acquiring. That's the technical term. What it's essentially saying is for every single asset that you want to buy, a separate limited recourse borrowing arrangement or bear trust is required for each individual property title. What does that mean in practice? So we've got the ACME SMSF here. We've got two blocks of land that are next to each other, and each of those blocks has a separate title, but the owner is only going to sell them as one parcel. And there's no impediment to those two blocks of land being sold separately at some point in the future. Under superannuation rules, those two blocks of land are not a single acquirable asset that need to be acquired under two separate LRBAs. So the transaction can still be done at a high level. What it means is there's just two applications, there's two bear trusts, there's two lots of paperwork, and unfortunately two lots of fees. I had a recent example of this. I had a small office suite. It was two suites side by side, 11A and 11B, and the wall between them was knocked down. So the occupants were using that as one suite. You would think, when you looked at that, it was one single acquirable asset. But on title, it was two, and therefore it was two applications, two sets of fees, etc. So there is a caveat here. If there is an entity that unifies those blocks of land, i.e. there's a factory or a warehouse or something standing across both titles, and that adds considerable value to the land, it can be what's called a unifying physical object and can make that into a single acquirable asset. Now, if that warehouse was derelict, however, in a knockdown, that would not be the case. So just a little example to be aware of there. Quick case study on loan servicing constraints. Generally, the lenders require 2 years of contribution history and the rental income to determine loan servicing capacity. One or two lenders will look at 2 years, the average of the 2 years. One or two lenders will look at the lower of the 2 years that have just passed. And then there are lenders that will look at the last year in isolation as well. So you've got options there, but depending on lender policy, you may need to go to one. What we often see, particularly with self-employed clients, is that they've got clients that haven't been paying regular or substantive superannuation guarantee contributions every year. So they've got lumpy or irregular super contributions, which is constraining their loan servicing capacity. So a clever little end of financial year planning strategy that we've come up with that's acceptable to a couple of the lenders that average is pre and post 30 June is to start thinking about this and having your clients make a substantive contribution, whether it's superannuation guarantee or non-concessional, pre 30 June and another one post 1 July, and that can then count as a 2 years contribution system, and they can start purchasing in the months following. So that can be a good way of getting around it. Just highlighting up on screen here a think tank form. If you're new to this space, it's actually quite a handy form. I used to reference it quite a lot when I started it with SMSF lending. I've built this into my system now, so I don't use it so much now, but if you're a newbie, this could be a really good one to have on file, which is the LRBA Essentials Guide for Think Tank. SMSF setup and broker role. This slide is important for two reasons. Just what role you play in setting up an SMSF and how long it takes. So if you've got a client who's had the barbecue conversation on the weekend, their friends bought a property in SMSF and they've approached you as their trusted broker on the Monday to talk about setting one up themselves, you are certainly not allowed to give that advice. So word of caution there, you're not allowed to talk about the setup or structuring of an SMSF. That's in they can instruct their accountant to do it, or they can seek advice from a SMSF specialist financial planner who can assist them with that. We always refer our clients off to an SMSF specialist planner or an accountant in the first instance if they don't have an existing SMSF to get it set up. Being aware of the timelines is important, and you can coach your clients on how long this might take. So to set up that fund and obtain the SMSF ABN can take up to 28 days. There are some accountants that are very good at this that can do that a lot quicker, but generally allow up to 28 days. In fact, it has taken longer for me on occasion. And then they've got to fund it. So they can't actually fund it by rolling over their superannuation funds from their retail or industry funds until the ABN is in place. So they've got to wait for that 28 days or thereabouts, and then start the rollover process. Now, depending on who their superannuation provider is, that can take anywhere from a week to another month. So, from go to woe with a client, making a decision to set up an SMSF, it can be 2 months. This is important if they're going to, if you're getting a pre-approval prior to them setting that up, to give them peace of mind that they can do this before they take the plunge to roll over. They shouldn't be then out looking and actively looking for properties, because they'll have an inability to put a deposit down until their funds have rolled over and that fund is funded. So just a word of caution there from a timing point of view. Once they do find that property, we advise clients to seek 3 to 4 weeks on the contract finance due date, which just gives them, so irrespective of whether they've got a pre-approval in place, the lenders will take at least a couple of weeks to move to formal post-contract of sale. We also suggest to clients that if they can, without killing the deal, extend the settlement date out to 8 weeks, that they should, to allow that extra wiggle room with the lenders. Jiaming, did you want to comment on any of that?
Not so much. I mean, not so much on the setup side of it. I mean, coming from a wealth management background the last 15 years, I support and want to reiterate, be really careful in terms of the advice you give people, right? So again, the regulator does have encourage people to have at least $250,000 in order to start that. And there's a reason for that. There's regulatory costs, there's auditing requirements or what have you. And, particularly, I know coming from the financial industry, there's layers and layers of regulations in there in terms of what you can and cannot. So I always say to people, buddy up with a really good accountant And accountants can't actually give advice either. All they can do is set the SMSF up. So really know who plays what role in the industry. Maybe network with a great financial planner. They're also great people to be referring business to anyway, to be able to help you. They will help the client understand what's going on. You have a very informed client. It's going to make your job so much easier as well. Mark, there's a couple of points in the previous couple of slides I just want to sort of point in before we sort of go too far, and that is that going back to the single acquirable asset, that's okay. The one case I had in the past, which I think is worth noting, is you can have two SMSFs own one asset as tenants in common. So I've had a situation where, it's brothers who had their eye on a factory. Right? Brother A has his own SMSF, brother B has his own SMSF. They're not in the same SMSF, but they want to buy the one asset, right? And they can do it via tenants in common. So that's one thing. In terms of servicing as well, I know we at Don't Money have this product and several lenders also do, okay? And that's called a quick refi, right? If you've got a mature SMSF in a bare trust that has very good repayment history for the last 2 years. Okay. In some cases, if some lenders, I know we've approved one where LVR was quite low, but they've only established their SMS for a period of 12 months. Great repayment history. The rental income from the asset was a lot higher than the minimum repayment amount. All we can do right there is just based on that, do a very fast refinance. Of course, best interest duty involved. When you refi over, the new rate has to be better than the old rate. But that's just something to remember. If you do have a existing SMSF, right, and they do have a loan in there, it doesn't always have to be that cumbersome and that much of a headache to refi. There are some instances where refinance can occur quite quickly without too much work involved.
Very good. Thanks, Charlene. I'm just looking at the time, so I'm going to press on and try and whip through the next kind of lender deep dive as quickly as possible, so we might be able to allow a couple of questions at the back end. But general lender guidelines, and this is at a general point of view, is that the lenders are generally looking for a starting balance of greater than 250, and that's in line with the ASIC guidelines in this space that SMSF shouldn't be set up with less than 250. I agree with that kind of statement. Some lenders will allow you to set it up with less, but you're not getting much bang for your buck, even at an 80% LVR with less than 250 in super. Liquidity post-purchase. Even if a lender doesn't mandate it, I'm often coaching my clients that they should leave some liquidity post-purchase. That might reflect, between 5 to 10% of the loan amount, or at least cash reserves covering 6 months of expenses, particularly if, they're buying a commercial property that's untenanted at the time of purchase to allow for that vacancy. Otherwise, they may need to be making contributions out of cycle. DSCRs and ICRs, the coverage ratios there are pretty standard. I won't go into them. Some lenders require a statement of advice. I think it's prudent that all clients that are operating in SMSFs and investing their assets should be getting the advice of a qualified SMSF specialist planner in this space. Going to deep dive into each of the lenders now. Liberty, one of my go-to lenders from an SMSF point of view, really great BDM support. So shout out to Gab, who's always wonderful in my business on this. Quite a good product offering both in the resi and commercial space. A little bit expensive at the moment, but a couple of little niches that are great with specialised security. They'll take 100% of the market rent for commercial, 80% for resi. They're very good with that flexible contributions policy that we talked about, or strategy that we talked about earlier. They're the only lender in the market that offers up to 90% LVR with no LMI in SMSF, and they'll only do that for sophisticated investors. So if you've got an investor that's got, maybe buying their third, fourth, fifth property within an SMSF, that's a reasonably cashed up fund, they can go to 90% to get those over the line for those kind of more sophisticated SMSFs. They do offer free bare trusts, trust deeds. The only limitation, I think, is they've got no servicing calculator. I know they're looking to fix that, but you've always got to go to Liberty scenarios to get that done. They do allow individual trustees, and they do allow related party loans as well. First Mac, another good lender, resi only, always running a really good kind of 80% LVR special broker rate. So if you've got resi loans that are right at that 80% threshold, First Mac are kind of my go to there. Generally got a pretty sharp rate for that. Really simple process with their calculator and their broker portal, and relatively low cost in terms of setups. Don't allow related party loans, but do allow individual trustees. Granite, another one of my go-to lenders, one of only two lenders that I work with that offer 100% offset. I'll do resi and commercial up to 30 years. I'll do NDIS within SMSF up to 25. Very good with kind of some specialised assets. They're the only lender on my panel that will do that service department I mentioned earlier. They'll also look at Airbnbs on a commercial basis as well. And they've got, much like Xiaoming talked about with Dough Money, they've got their easy refi, which I've done several through, which is really good. Latrobe, really good lender in terms of finding a home for SMSF deals that can be difficult to place. They might be more regional, specialised securities, larger loan size. I've got one that I really struggled with, that little, there was a retail premises down in Sussex Inlet, done with them when I could get it done nowhere else. Really great BDM support and no independent financial advice required. Really good loan sizes there as well. Think Tank are good on that strategy that Xiaoming talked about, that tenants in common one. So 2 loans for 2 SMSFs on 1 asset. Also good with unit trust structures. So kind of get that more high level strategy from an SMSF point of view. Can use last year in isolation from the contributions, which is good. No liquidity requirements. Better mortgage management, really good mortgage manager, similar kind of offer to Granite. Also offer that offset, good BDM support, and yeah, pretty standard. Otherwise, AFG Home Loans, reasonably new entrant in this space. Thing I love about AFG is their SLA. In this space, this is a real game changer for us. If you've got a deal that you really do have a timeline on, AFG would be my go-to. They only do resi. They have dropped their fees recently, so they're much more competitive in that place. And also, if you're priced up 70 LVR, they're quite well priced. They do have that 10% liquidity requirement, but you get direct access through the credit assessor, 48-hour SLA. It's a really good one for a simple resi purchase or refi. So, Money, Xiaoming, I'll let you do the honours on this one.
Well, we're one of the newer players in the market, but we certainly want to make a name for ourselves because, I do have, as one of the founders, I do have a passion for self-managed super fund. So we're always working to hear everybody's feedback. One of the things I want to say is, look, we do have a maximum per borrower exposure of $3 million, but every single asset, we have a max of 1.5. For a 80% LVR. However, if you require something that's a little bit higher in terms of the amount, we can certainly assess it by case on a lower LVR. Some of the niches, I suppose, we also offer 100% offset. There is a 0.1% loading, which is something I'm happy to disclose and not put into the fine prints. So that's okay. But outside of that, we lend for residential 80%, we lend for commercial at 75%. We certainly do pre-approvals as well. And we have a very responsive team, supporting team. We assess an NSI of $500 per annum, and which makes qualifying a lot easier as well, and also along with that quick refi product also. So a lot of things from our our product is on a case-by-case basis. So always feel free to send cases through.
Cool. Thanks, Xiaoming. Bluestone, new entrant coming soon. They're only going to be doing resi, so I don't know much about them at this point, but I'm looking forward to them adding to the panel. There are a couple of private lenders on the panel that will do SMSF. Really, these just form like where I see these having from a strategy point of view, some applicability is you might have a client who's looking to buy their commercial property. They need to act soon. They don't have a contributions history that they can use. Therefore, servicing is non-existent or constrained, they could do a private lending solution for between 12 and 36 months, get that contributions history up, and then refinance to a mainstream. That's kind of where I see them having a place. I haven't had to use them yet, but that is how I would if I had to. I'm going to just kind of breeze over these refinance case studies, other than to say that, you know, there are great opportunities to refinance clients. This was a granite easy refi where, you know, we were able to save kind of 10 grand a year for these clients. Another one with a commercial property. We're starting to see commercial rates tick up, and there should be some good opportunities there. SMSF rates, these are the cheapest rates in market at the moment. You can see here, even with a really low LVR, 60% LVR, we've got rates now in the fours. Well, only one with a 4 in front of it and the rest with 5s. But those assessment rates are ticking up to, you know, in the commercial space there at 8.49. That could, by all reports, be a 10, you know, in the not too distant future. So servicing is severely constrained at those kind of rates, so just something to be aware of. Just my SMSF lending disclaimer, all of the above information is provided as a guide only. As I've suggested, this is a complex area. It's governed by, you know, the ATO, the Superannuation Industry Supervision Act, the SIS Act. Being around that is important. If you want to demonstrate expertise, it's something, write a book. It was my whole mantra, so I wrote this SMSF lending playbook. It's a little ebook. It's a client-facing book available on my website, which educates clients on how much they can borrow. Launched that only about a month ago. It's been very well received. What does an SMSF specialist look like? So if you're considering going into this space, my advice is if you're a broker of average ability with only average experience, this is probably not the space for you. I think it's a space for a broker with a, you know, high level of education, a minimum diploma kind of level, you know, either 5 years kind of plus broking experience, because you're not just dealing with a resi loan. It could be a commercial loan, but you've got a whole superannuation overlay on top of that. So having that kind of demonstrable superannuation knowledge or strong finance, banking or super background is really important. Or getting mentoring and coaching so that you can build that skill set from someone that does. Obviously being accredited with your aggregator, having a team at scale to support you and systemised process, and obviously writing a regular monthly volume of clients. And how do you operationalise SMSF lending in your brokerage? You know, the key things you should be doing are looking to upskill yourself and your team. So as I said, get that coaching, mentoring, whatever it might be. Do the SMSF courses that are available through the MFAA, the SMSF Professionals Association. Look at how you can automate your SMSF document collection. You know, build SMSF specific workflows, checklists, task management functions, processes and procedures that can make this process a lot easier. If you're using Broker Engine, you know, Broker Engine out of the box doesn't really cater that well for SMSFs. I've created an advanced Broker Engine blueprint under my other business, Decipher Expert. So if you're looking for a bit of guidance on how you can kind of fast track that, you know, and operationalise SMSF lending in your brokerage, if you're a Broker Engine user, check out decipher.expert. And that's it from me. Thanks. Back to you, Zarko.
Now, we have a hat full of questions that we aren't going to get to today. So what we will do, we will distribute the questions amongst our speakers, Mark and Xiaoming. And Mark and Xiaoming will answer those questions and come back to those people who have posed them. Xiaoming, any last words from you?
Yeah, well, I guess we are new. We're not on panel yet, but we will, and we're constantly revising our product. But that also means that we have an open door policy, and we are listening to our lenders, our brokers, in terms of their needs and the areas that they find difficult in working. So do always reach out. Feel free to speak to me. You know, whatever deal that you have, we love to hear about it. And if we can help out in terms of the policy-wise and things like that, we certainly go the extra mile. So, yeah, that's all I have to say at this stage, I suppose.
Now, if you would like information on any future training opportunities in the self-managed super fund space, reach out to me directly. I will connect you with those opportunities. If you would like me to connect you with either Mark or Xiaoming or both, reach out to me directly. I'm happy to be the conduit for that. Thank you very much for joining the webinar today. The webinar has been recorded and will be housed on the Learning Hub very shortly. So look out for that in the coming days. Thank you very much for investing the time. Do the work if you want to get into this space. It is rewarding. but it is complex, it is regulated, it is involved. Stay positive, stay productive, and bye for now. Thank you very much for joining the call.
Bye, everyone.
Bye.
You okay, beautiful?